Please put your hands together for the moderator of the first panel, Wale Famurewa, who is the non-executive director at Cardinal State Securities and my colleague at CNBC Africa. Wale, please. Wale will be here to introduce his panelists. Then, of course, they will have about 45 minutes for the first panel.
Good evening, everyone. It's great to be here. I'm delighted to moderate the next conversation around the role of the financial markets in unlocking capital flows into the real sector. And without further ado, I'd like to welcome the panelists. We will be starting with a lead speaker to set the tone for us, and representing Mr. Tony Elumelu, the chairman of UBA and Heirs Holdings and Transcorp, is Chukwuma Nweke, Executive Director, Operations and IT at UBA. Please, can we put our hands together for him as he comes? And joining the panel will be Deji Adebusoye, Vice President, Sahel Capital, who is representing Mrs. Ndidi Okonkwo Munile, co-founder of ACE Food Processing and Distribution. Is Mr. Peter Bankole here? Oh, wonderful. Yes, please, can we put our hands together for him? He is Director, Enterprise Development Center at the Pan Atlantic University. We're sharing some really useful insights into the lives of SMEs in Nigeria. And we're also expecting Ms. Yohande Sadiku. I know she was on her way, but I guess she will join us at some point. Okay, wonderful. So, thank you so much, panelists. And on that note, I'd like to hand over to Mr. Nweke to deliver a short opening, some short opening thoughts on the topic, and then we'll get into the panel.
Good evening. Good evening, ladies and gentlemen. Few disclosures. The paper I'm about to present today is written by Mr. Tony Elumelu, CON, so he takes the full credit of what I'm about to say. I would like to break some of the rules of good public speaking. In high school, we were told never read a speech. But I'm going to read the speech of Mr. Tony Elumelu because of three reasons. He's an accomplished entrepreneur and a businessman. So the thought he has penned in this paper, I need to share it with you as if he was here. The second is from the part of the country where I am from. If your king sends you on an errand and asks you to go and deliver a message, and you go there and deliver something different, when you come back, there's only one consequence. They take your farmland. And all of us know what farmland means in 2018. The final point is politics is in the air. So I'd like to remain with the script he has written, so that when the pressman quotes, they will quote him verbatim. He has the muzzle to be able to take the hit. It's a 10-page document. 10-page document. Would you believe that? So I have 15 minutes to summarize these 10 pages. So bear with me. The presentation is in 4 parts. The first part is to consider the design of the financial system. And he made a poser. Does the design of the financial system matter for economic growth? And he will raise some points where he addressed that. The second part is the challenges faced by the real sector, especially the SMEs and the agricultural sector. The third part is the role of financial markets in unlocking capital flows. And the fun part is the conclusion. So let's begin. So he asked, does the design of the financial system matter for economic growth? And he made these various points. At one extreme, researchers reveal that countries like the US and the UK have market-based financial systems where financial markets play an important role and banks are less significant. At the other extreme, countries like Germany and Japan have bank-based systems, where banks dominate credit allocation and financial markets are not very important. The bank-based view holds that bank-based systems, particularly at early stages of economic development and in weak institutional settings, do a better job in capital allocation and in mobilizing savings. And in recent times, researchers have provided additional findings on the finance growth nexus. And the conclusion is that at firm level, at industry level, and cross-country studies all suggest that the level of financial development exerts a large positive impact on economic growth. The financial system provides an enabling environment for economic growth and development, productive activity, financial intermediation, capital formation, and management of the payment system. In many developing nations like ours, limited financial markets, instruments, and financial institutions, as well as poorly defined legal systems, make it more costly to raise capital and may lower the return on savings or investments. While banking practice and financial markets are important predicates to the economy, the financial market is the cornerstone because it creates wealth from which savings accrue and form revenue sources for the banks, which banking institutions utilize as redistributable assets on collateralized principles. Therefore, Mr. Elumelu makes this point. A lopsided growth in favor of banking practice creates a usurpation of functions of the financial market, confusion of roles, and reduction of others' economic importance. Therefore, there must be a balanced growth of all segments and sectors of the financial market, as it is pivotal to the resurgence of other sectors. The second part talks about the key challenges that SMEs and agricultural sectors face. One key one is lack of access to finance. And in dealing with this, he talks about not only finance, but the right source of finance. This is perhaps the most common constraint to small enterprises because of problems of collateral, high interest rates, extra bank charges, inability to evaluate financial proposals, and numerous challenges that they face. The second point he raised is lack of government-provided incentives. He believes that the incentives so far are still inadequate in terms of tax holidays, subsidized land, low-interest loans. It means that starting up a business is costly for an average Nigerian entrepreneur. Incentives are necessary for entrepreneurs to thrive and scale in their respective industries. The fourth point is inadequate infrastructure. AFDB estimates that Africa needs about 93 billion every year to bridge the infrastructure gap. Our own CBN estimates that the infrastructure gap in the Nigerian economy in 2011 at 140 billion and projects that the government should need 14 billion annually for 10 years to achieve its Vision 2020 development aspirations. The underdeveloped state of infrastructure means that it is more difficult for entrepreneurs and SMEs to assess important factors of production. The absence of reliable ports, rail, and road network means that access to input is not always guaranteed. The majority of the Nigerian population, 60%, conservatively lack electricity, and as such, approximately $13 billion is expended on fueling power generators and the economy, and there are losses of 320 working days annually to power outages. And finally, he says there are weak institution concerns. The inherent inefficiency in the capacity of existing institutions has continually hindered effective real sector development. Weak institutions, vague delineation of rights, weak enforcement of regulations, and bureaucratic bottlenecks in the legal system adversely impact the incentives of economic agents. Role of financial markets in unlocking capital flows, the third part of his presentation. Mr. Elumelu makes the argument that the real sector is strategic to the growth of any economy. The industrial sector is a key segment of the real sector in Nigeria and has annually contributed more than 15% to our economy in the 21st century. The financial sector is critical to the growth of the real sector. It provides an appropriate avenue for funds to be pulled together and risk diversified to fund economic activities, which would otherwise not have been funded. In the absence of the financial sector, the cost of operations and funding risky ventures by the real sector may be prohibitive and may discourage participants in such activities. Bringing these points home, in February this year, United Bank for Africa and PLC and China Development Bank, the world's largest development finance institution, signed a $100 million 7-year loan agreement to finance the development of small and medium-scale enterprises in Africa. The facility will enhance UBA's capacity to provide access to finance to small businesses across the 20 African countries where the bank currently operates. In addition, we have an agreement with the Agence Française du Développement, France Public and Solidarity-Based Development Bank, to utilize the URIs and ARICS schemes to fund SMEs and startups. We believe that these interventions, in addition to what the regulators and development finance agencies are doing, are critical to helping the SMEs and agribusiness to thrive. Finally, in conclusion, the role of financial markets is vital for inclusive growth in terms of wealth distribution and making capital safer for investors. Financial markets can create greater financial inclusion by introducing new products and services tailored to suit investors. A well-developed financial market creates a sustainable growth and low-cost distribution mechanism for multiple financial products and services. The Nigerian Stock Exchange, in its effort to boost SMEs, created the Alternative Securities Market, a specialized board for emerging business, small and mid-sized companies with high growth potential. It gives such companies the opportunity to raise long-term capital from the capital market at relatively low cost. However, there's still a lot of work to be done. The Nigerian government should design an accessible and a well-supervised SMEs credit scheme for the development of the sector, an appropriate environment and infrastructure facilities for SMEs. The government should also influence the foreign exchange rates by positive economic reforms through its monetary policies that reduce the adverse effects of unstable foreign exchange rate on the Nigerian economy with respect to trade flow. This will induce growth in these sectors. Thank you very much.
Yeah, thank you very much, Mr. Nweke. I think it's safe to say that his farmland is safe after delivering that very well delivered speech. So thank you so much. And I think that sets the tone very well for what we want to discuss. And I think that at conferences like this, there is a tendency to more or less reiterate the things that we already know. But what I think will be more valuable is to hear the unique perspectives from the experiences of the panelists on the topic. So I'd like to start with, by the way, Ms. Yewande Sadiku joined us while his speech was on. Please can we put our hands together for her? Executive Secretary of the Nigerian Investment Promotion Commission. And I'll be coming to you first, Yewande. And if you can just, speak to this topic from your experience as an agency that is trying to galvanize investment flows into Nigeria. The financial markets obviously are critical. You have very rich experience in the financial markets yourself. So can you just speak to this point to set the tone for us? Go ahead. I think it's on.
Thank you. First, let me apologize for coming in late. I was on a 10:26 flight from Abuja, which did not leave until past 2. So I did my best to get here, as quickly as I could. But in my own experience, generally the sectors that don't enjoy the support of the financial markets are not as sophisticated or as formalized as they could be. Agric is one. A lot of what happens is subsistence farming. Not many access the support of the financial sector. Nigeria's entertainment industry, rated as first, second, or whatever in the world, depending on who you're listening to, again has grown based on the sheer based on the sheer grit, if you like, of participants, without access to formal financing, the need for, the rigor and discipline and governance that often helps enterprises grow is not there. So it's important, if this sector is to grow, that both can enjoy the benefits of formal financing. But agriculture is a complicated one. As big as it is in its contribution to GDP, the single largest contributor to our GDP is crop production. But a lot of what is produced, doesn't get to, essentially gets thrown away because it is not processed, because it is not preserved. And there are elements of getting that from farm, if you like, to fork, or even better, from seed to fork, that the financial sector can help unlock. If we look at crop production on its own, then we will not make material progress from where we are. If we think of the full value chain, everything that is required from logistics to manufacturing and processing, and the transport infrastructure, that is required. I also find that government crafts policies that make sense, albeit with targets that are sometimes very ambitious. But if you look at the policy without the restrictiveness of the targets that are set against it, that those policies make some sense. But there isn't enough partnership with the private sector. This government articulated the Economic Recovery and Growth Plan. The document was put together with engagement with a wide number of parties. But it set targets that, if Nigeria could meet, could help us achieve the diversification that we need. But 80% of the capital that is required, 80% of the investment that is required to achieve the targets set in that document are supposed to come from the private sector. Yet it is largely regarded as a government document. I also find, in asking for support from government, just as Chuks mentioned when he spoke, the private sector speaks to, it'll be good for government to do this, it'll be good for government to do that. I don't know when last any one of you dealt with government, but you know the people who work for government. So telling them it'll be useful for government to do this and that, I don't know that will change the needle. You almost have to be prepared to sit in government offices, to roll up your sleeve, and to help with the articulation of the policies that will then make that happen. So the people, like me in government, can then push these materials through. But the crafting of what may be beneficial, the private sector needs to support. There was a mention when Chuk spoke about the need for incentives. My personal view of incentives, and the view I took before I went into government, is that the first incentive that a business needs is simply a profit motive. If you deem that that venture, is profitable enough, then it is interesting. You should not require, the kind of support, it's the context of a child who gets carried around all the time, may never learn to walk. But there are incentives that government has already that many are probably not aware of. And in particular, in relation to NIPC, in November last year, we put together a compendium of investment incentives. It tried to bring together, across the board, all of the incentives that exist for investment in Nigeria. But there's a specific page in that document that is dedicated to agriculture. There's none dedicated to SMEs, but there's a specific page that is dedicated to agriculture. And that gives relief for small, because that's how everybody starts. That gives relief for small investors in agriculture. That gives capital allowances up to 95%. They enjoy a lower tax rate than the standard tax rate. I believe it's 20% for 5 years. But there are a number of incentives that operators are not even aware of, partly because they operate largely informally. If they had the benefit of professional advice, and I dare say that a lot of the smaller companies cannot afford the quality of professional advice that will actually make a difference to them. So those who need it the most cannot afford the best advisors.
Very useful points, certainly. Mr. Bankole, I want you to also chime in here. when she was making her point earlier, she talked about agriculture, and so much has been said about the value chain, and we hear these issues, we hear about this opportunity all the time, but it does appear that being able to tap those opportunities and to get financing to them has been relatively slow. I think one reason perhaps would be capacity, and I know you certainly know a lot about SME capacity building, so maybe you can speak to this point and how we can try to build capacities such that we can now get the formal financial markets involved in raising capital for ventures in Nigeria.
Okay, thank you, Wale. Two things. The first is we need to understand that the business models must change. In fact, they are changing. The people that are operating in most of these sectors, they are young people. Take, for instance, in the agric space, you have the likes of Farm Crowdy. Farm Crowdy does not plant the way we used to know it. Young people will focus, you divide it into two. One is the production side, and the second one is the moving the product to markets. So the on-farm and the off-farm. Most young people tend to walk around off-farm. And that is, again, where the agribusiness tends to play. And until you are able to optimize that part of the value chain, the problem of farm to fork and losing close to 40% of yield will continue. Now, as far as capacity building is concerned, it's not only in the agri-space. It's basically in all the sectors that the small and medium scale enterprises play. From my experience, the challenge is that even when you build their capacity and they are able to reposition in terms of their business models, they do not have access to long-term financing. And that distorts a lot of things.
But sorry to jump in there. If they have the capacity, then why aren't they getting the access then?
Okay,
do they need to reorganize themselves in a certain way?
First of all, it's about mindset. A lot of
mindset of the capital providers?
Exactly. That small businesses are very risky. To some extent, it is true, or it used to be true. But there are new, I would say, evolving SMEs now in the space, especially those that are coming from the diaspora. The way they think is different. You would see what is happening with fintech. You see what is happening in PropTech. You see everything is just being disrupted. And so it is important for those in the financial services sector to begin to understand these people, because they are not playing in the old SME ways, okay? Until that is done and clearly understood, we will continue to have this mismatch. These guys have a lot to offer. It is true, and I'm happy you mentioned something about those in the creative industry. It's the same. Those guys just basically bulldoze their way through. No government support, no infrastructure, no anything. And all of a sudden, we are clapping for them, and we were never part of that struggle. Just very recently, even Netflix celebrated one of our own. So they had the best movie coming on. And I am sure that very soon, a lot of Nigerian movies are going to be in the global space. But it is not about the incentives that the government has provided. It is not about the infrastructure that we have on ground. It is shared doggedness of these people.
All right, thank you so much for that contribution. DJ, I want to move over to you. You're in the PE space, and basically you look for capital where you see you can get you invest your capital where you think you can get a return. Speak to your experience, especially in this era of greater digitization, how we can get financial capital to the businesses that we need that need this capital.
Thank you. Okay. All right. I think there's a saying that goes across the social media platform these days that says, "What you don't know, you don't know. What you know, you know." One of the things I've realized, having been in this space for a while now, is there is a mismatch somewhere, and that is the fact that a lot of the corporate guys that hold the key to the vault of money. I mean, you all are sitting here in our ties and our shirts. And the farmers are a completely different set of people. We really don't understand them. Recently, I sat with a couple of people, in this sector, in the financial sector as well, that actually came to ask questions about the agriculture sector, trying to understand, because they were looking at how to direct, resources to make it available for, farmers in the form of farm crowdy, farm crowdy and the others. So I think one of the most first important things we need to do is to spend time and invest time to understand the sector. Spend time to, either staff yourself to understand or spend time with the farmers to understand the problems and the challenges they are facing. Now, some of the things we've realized as we've tried to pool money and invest in the sector is that you also cannot. The world has gone beyond the age of we are farmers, we are just planting corn, planting maize, and all that. If I ask a very general question here and ask how many of us in the rave of agriculture has dabbled into agriculture and we dabbled out as quickly as possible, I'm sure many hands will be up, because we really did not understand the risk in it. And that's what we keep finding, that as many people that are going into the space, they really don't understand even themselves what they are doing. But what we are trying to do is to bring in that level of understanding into farming and bring it beyond farming and take it to the level of processing. Because at that point, it begins to make sense. It begins to look, have the glam and the glamour that people want in that sector. So the moment we begin to combine and integrate end to end, it begins to look more attractive to people and even to financiers to put in their money in the sector.
Well, let me ask you this question. Since you've been dealing with the agriculture, businesses in the agriculture space, one of the things that I would certainly love to see is some, if you like, securitization that can bring down the cost of capital for many of these businesses. What would you say about the risk, should I say the lending risk that you see in the businesses that you're dealing with versus the cost of capital in the markets right now? Do you think there is a clear case if we can better understand these businesses and to bring down that cost of capital simply because they're not as risky as we think they are?
No, I mean, I would say they are risky. Recently, we all understand the issue of the flood that just happened in Niger. It wiped out a lot of farms, and that's the reality. It's a risky business. And one thing I say very often is crops are living things. It's like a baby. It's not like you're just buying shoes, making shoes, and selling shoes. It's like a living thing. So you're spending the time. So it's risky. But even at the same time, the more we spend time to understand, the better we are able to structure products or structure, financing that caters specifically to the sector. In our investments, based on the experiences that we've had, we've begun to come up with certain terms, structures that protect us as investors, such that if there is any downside, somehow we are still protected, and also even the business itself is protected. Nersal is, for example, is becoming more active as well in the sector, helping to finance or to ensure the financing in the sector. So I think these are some of the areas that we need to look a bit more into in terms of de-risking the investments.
And it's interesting you mentioned Nersal, because at the end of the day, I imagine that it's going to be a case of collaboration. Agencies like Nersal, the financial intermediaries, coming together with the businesses and perhaps even their trade groups to see how we can better position these businesses to receive this capital. So let's speak to those who are providing a lot of this capital, the bank. So, Chukwuma, if you can speak to this topic as well. From your experience, a lot has been said about how we can get better capital to businesses at a cheaper rate. A lot has been mentioned also about trying to understand these businesses better. Share your experience in terms of dealing with small businesses and the opportunity for us to get for the financial markets to contribute a lot more to their success.
Okay, thank you. I will just step back a little bit with the experience we have with entrepreneurs across Africa, working with the Tony Elumelu Foundation, where he provides 10,000 seed capital to 1,000 entrepreneurs on a yearly basis. One of the key points we've learned over the 4 years we've started this program is that as important as capital is, that's not the key thing that makes the SMEs to thrive. One of the things we've learned in this journey is that the education that they get, the mentoring they get in that journey is as important, if not more important, than the capital that we provide them. Because what usually happens is that you give them the capital, they start the business. Some of them are not well structured. They don't understand the market. They don't understand the planning. They don't understand the financing. So they run into a little bottleneck and the capital just goes down the drain. But with mentorship, we assign people to them who have done this business, who understand the cycle of businesses, who understand what needs to be done to make a successful business, who handholds them to make sure that they thrive. We think that that's one key element that is missing as we try to grow the SME space. The second thing we've learned for the agri sector, which we think we need to all work together to address, is the risk sharing both for the SMEs and for the agri sector. Our experience in the market space is that you take an insurance cover against crop failure, for example, through the NAIC, for example, and there's an incident like my colleague just mentioned now. Then it takes you like about 3 years to recover anything from NAIC. Now that creates a problem for all the stakeholders in the chain. Therefore, we need to all find a way to make sure that when you take a risk cover, that when the risk crystallizes, you get your money back, so to speak. The third point is in the area of risk sharing from some of the developmental finance companies that government has set up. What usually happens is that you have some of them ask you to take the risk. Then they give you a spread of 2%. You take a capital charge. Then you take the credit risk. Then banks are into business. They will make commercial decisions. You're giving me liquidity. So you're giving me liquidity, asking me to take a credit risk for a little margin, a hit on my capital. So banks usually are not interested in doing that. They would rather use their liquidity to lend. But if you have a model where there's a risk sharing, I think we would make significant progress in doing that. Some of the arguments that have been made is that some of these entities, they borrow the money from development banks as well offshore. Therefore, they are constrained, that they are not properly capitalized. But if we need to make progress in this space, we need to make sure that they are properly capitalized and that they play their role adequately by engaging in risk sharing. You can't transfer all the risks to banks and give them 1% or 2% as a margin. The risk-return trade-off doesn't work that way.
Thank you very much for that contribution. As we know, we started the event a little late, so we are a bit constrained for time. But I would like to still open this up to the audience for those who would like to share their perspective on the topic. I think what we're trying to achieve here is, to throw out some ideas on how we can get the capital flowing more to small businesses and using the financial markets to enable that. So if you do have a question or contribution to make, please feel free to put up your hand and a microphone will be brought to you. Okay, while I wait for that, do you want to make another comment?
Yeah, I just want to share a few things we're learning as well. Last month, we did a comprehensive survey for DBN across the country. And it's very interesting to note that we talked to some of the banks as well. We interviewed about over 2,000 small businesses across sectors. Really, I agree with Chooks. Financing is not the number one. Actually, it's number 3. And in terms of requirements, majority of them do not need more than between 5 and 10 million. Not more than that. So it's small money, and I can relate to that because majority of the MSMEs in Nigeria, majority actually micro, not even small. And so the requirement is very
But that 5 to 10 million, is that more of grant funding or debt?
No. Again, for loans, the challenge in that request is that if it's more than single digit, then that's already a problem. And so the conversation is, can we truly lend to MSMEs at single digit? That's the question. Knowing fully well that the likes of CBN, Bank of Industries have been doing something around this and maybe creating this impression that this is very likely. Whether it is Anchor Borrower Scheme, which the lady mentioned about, whether it's the BOI, whatever, MSMEDF, all of them single digit. And that has basically, focused the attention of those in that space that once it's beyond that, then we cannot take it.
Do we have any question or contribution? We are really short. Maybe we can take one or two if we do have any in the room. Otherwise, we really have to move on to the next panel. Okay, I think that you guys have done a great job. Thank you so much. Please, can we put our hands together for them? And on that note, back to you, Bosun.
What you and your team was able to provide in terms of some clarity in certain areas when we look at the Nigerian financial system and what the system can do to support capital flows into critical sectors such as agriculture and SMEs. Thank you very much, Wole. Thank you. We appreciate your time. Yemi Sadiku, thank you very much. And other members of the panel. Please give them a round of applause as they go off the podium. That was brief and straight to the point, and we encourage everyone in the audience to please make your contributions. We look forward to that. It makes it all more robust and enlightening for every one of us. I think we want to take the second panel, which is also very deep, taking a different look